When you're dealing with the IRS, well, you're up against one of the most powerful collectors out there. Seriously
Oh,
powerful.
absolutely. They can grab assets, freeze bank accounts, take your wages, often with surprising speed.
Right. So the big question we're looking at today, it's pretty fundamental. Does bankruptcy, the thing that can wipe out credit cards and medical bills, does it actually work against tax debt, specifically income taxes?
Yeah, that's kind of the ultimate legal showdown, isn't it? And the good news is, often, yes, it can work, but, and this is a big but, only if you follow a really, really specific set of rules.
Okay, specific rules. And for this discussion, we're digging into the strategies laid out by Peter Francis Geraci.
Exactly. We're focusing on the conditions he details for using bankruptcy as, well, a legal shield against the IRS. The aim here is to give you a clearer picture of those exact timelines and strategies he talks about.
Excellent. Okay, let's set the stage a bit first. When we talk bankruptcy, we're usually talking about two main kinds, right? Chapter 7 and Chapter 13. We'll be
Right.
using these terms a lot.
We will.
Could you just quickly sort of anchor the difference for us?
Sure. Happy to. Think of it like this. Chapter 7 is liquidation. That's the real reset button. Eligible debts get wiped out, gone.
Okay, wiped out.
Chapter 13, on the other hand, is reorganization. It sets up a mandatory repayment plan, usually over, say, 3 to 5 years. It lets you catch up on debts you can't just wipe out.
Perfect, got it. So, with that context, the source material says bankruptcy is one of the few legal tools that can actually stop the IRS. But you mentioned income taxes specifically.
That's the key legal distinction, yeah. We're
Hmm.
primarily talking about income taxes here.
So what about other kinds of taxes, like payroll or sales tax?
Right. Most of those other taxes,
Right.
sales tax, payroll taxes, what they call trust fund taxes, they're rarely, if ever, eliminated. The government basically sees that as money you are holding for them.
Ah, okay.
Yeah,
You collected it on their behalf.
exactly. But older income taxes, those are potentially dischargeable under Chapter 7,
Yeah.
provided you meet 3 very specific sequential conditions, all 3.
3 conditions, gotta meet them all. Why are these rules so strict? Is it, like, deliberately tough to get tax debt wiped out?
Well, they're designed to make sure, the debt is genuinely old, that the government had a fair shot at assessing it and collecting it, and crucially, that you were honest from the get-go.
Okay, so honesty first. What's the first rule?
Foundational. You absolutely must have filed a truthful tax return for the year in question. If you never filed that return, forget it. That debt's sticking with you.
Right, no return, no discharge. Makes sense. You can't ask forgiveness for something you never officially owned up to. What about the timing? The clock?
The clock is, well, everything here. There are actually a couple of clocks. First, the big one, the 3-year rule. At least 3 years have to have passed since the tax return was originally due.
Okay, the original due date. Like
Right.
April 15th, usually?
Usually April 15th, yeah, though sometimes it shifts for weekends or holidays.
Yeah.
Let's say the due date was April 15th, 2021. You'd have to wait until at least April 16th, 2024 to file bankruptcy if you want that tax year potentially discharged.
So 3 years from the due date. Got it. And you mentioned a couple of clocks. What's the other timing requirement?
This one's about the IRS's internal process. It's the 240-day rule. The tax must have been officially assessed by the IRS at least 240 days before you file for bankruptcy.
Assessed. What does that mean exactly?
Assessment is basically when the IRS formally records the liability against you. It happens after they process your return or maybe after an audit. That 240 days gives them a sort of final window after they've put it on the books.
Okay, so it sounds like meeting these rules isn't just about being broke, it's about patience and strategy. Wait 3 years from the due date, wait 240 days from the assessment, and make sure you actually filed the return in the first place.
Precisely. And there's one more little twist for people who filed their returns late.
Ah, the late filers. What's different for them?
If you filed the return late, that 3-year clock we talked about, it doesn't start from the original due date. Instead, there's a separate rule. You have to wait at least 2 years from the day you actually filed that late return before the debt can even become eligible.
2 years from the actual filing date if you were late. Okay.
Right. The core idea for Chapter 7 relief is still time and truthfulness on the return.
Okay, let's shift gears a bit. Let's talk about the immediate danger. Maybe you meet these rules, maybe you don't. But while you're figuring that out, the IRS might be coming after you hard. How aggressive are they compared to, say, a credit card company?
Oh, it's night and day.
Yeah.
Really. A typical creditor, like your bank or a credit card company, they have to go to court, sue you, win a judgment, then get a judge's permission to garnish wages. It's a process.
Right, there are steps involved, legal hoops to jump through.
Exactly. The IRS, they pretty much bypass all of that. They have the power to levy your income, seize money from your bank accounts, put liens on your property, all without needing a court order first.
Wow, no court order needed. That gives them incredible leverage, doesn't it?
Immense leverage and immediate power.
And the source material we're looking at, it mentions a really shocking number related to that seizure power.
Yes. The wage levy. If the IRS decides to levy your wages, they can take up to 80% of your paycheck.
80%? Seriously?
80%. Think about that. No other creditor comes close to that kind of seizure power. It's financially devastating, instantly. Makes it impossible to pay rent, buy food, let alone deal with the tax debt itself.
Okay, that's terrifying. Which brings us to why bankruptcy can be such a critical tool, even if the tax debt itself might not get wiped out in the end. The automatic stay.
The automatic stay, yes.
Right.
That's the immediate stop sign. The moment you file for bankruptcy, Chapter 7 or Chapter 13, this automatic stay kicks in.
Now, what does it do?
It legally halts almost all collection actions against you, instantly. So that IRS levy, stopped, wage garnishment, halted, bank account seizure, frozen.
Wow. So filing provides immediate protection.
Crucial breathing room. It forces the IRS to back off while you figure out your strategy, whether that's discharging the debt or setting up a payment plan.
Okay, so we've established, if your income taxes are old enough, you filed truthfully, met the time rules, Chapter 7 can potentially wipe them out completely. Great.
The ideal scenario, yes.
But what if they don't qualify? Maybe the taxes are too recent or you missed that 240-day assessment window. You filed bankruptcy, the automatic stay has stopped the bleeding, stopped that 80% levy, but the debt's still there.
Right.
This is where Chapter 13 comes into play. Yes, the reorganization plan.
Precisely. If Chapter 7 discharge is off the table for those particular taxes, Chapter 13 offers a really powerful alternative. It provides significant relief through a court-supervised structure.
Okay, and what are the main benefits of using Chapter 13 for tax debt that you can't just eliminate?
The advantages are pretty substantial. First, it lets you pay off that IRS debt over a manageable period, usually 3 to 5 years. You get time.
Okay, time to pay.
But here's the really critical part, the leverage. That payment plan is typically structured with no additional penalties or interest piling up while you're in the plan.
Wait, no more penalties and interest? Because those can be brutal with the IRS.
Exactly. Outside of bankruptcy, penalties and interest can easily balloon, sometimes even double the original debt over that same 3 to 5 year period. Chapter 13 stops that clock.
That's a massive financial difference. So filing Chapter 13 basically forces the IRS into accepting a payment plan that the court approves as affordable for you.
Yes, it totally shifts the power dynamic.
Yeah.
Look, you can try to negotiate a payment plan directly with the IRS and offer a compromise or something.
Right, people hear about those.
They do. But Chapter 13 generally gives you better terms, a longer payback period potentially, and most importantly, it comes with that absolute legal protection from collections for the entire duration of the plan. You go from being chased to having a court-backed fixed payment schedule.
That sounds much more secure. Okay, before we get to a specific example, let's just quickly circle back to those other taxes we mentioned earlier, the ones that aren't income tax. What's the deal with, say, trust fund taxes, payroll, sales tax, and bankruptcy?
Yeah, good question. As we said, those are generally non-dischargeable. Chapter 7 won't wipe them out.
Okay, so you still owe them.
You still owe them.
Yeah.
But Chapter 13 still offers a way to manage them. You can include those non-dischargeable trust fund debts in your Chapter 13 repayment plan.
Ah, so you pay them back over the 3 to 5 years.
Correct. And crucially, again, you're typically paying them back without any further penalties adding up during the plan. So you stop the bleeding, even if you have to repay the principal.
That's still significant relief, just stopping the penalties. What about things like property taxes, or just the mountain of penalties the IRS might have tacked onto older debts?
Property taxes are trickier. They might be dischargeable if they're overdue by more than a year, but it really depends heavily on local state laws. It's not automatic.
Okay, depends on location and penalties.
Penalties are interesting. Certain tax penalties can be discharged, but usually only if they're attached to older income tax debts that already qualify for discharge under those Chapter 7 rules we discussed, the 3-year, 240-day rules.
So the penalty discharge follows the underlying tax debt's dischargeability.
Generally, yes. If the old tax debt gets wiped out in Chapter 7, related penalties often can be too. But penalties on recent taxes or on non-dischargeable taxes like trust funds, those usually have to be paid back, though Chapter 13 can help manage how you do it.
Got it. This really highlights how specific the rules are. Let's try to make this more concrete. The source material uses a case study, Donald and Regina. Their situation really shows the kind of crisis people face and how bankruptcy offers different paths.
It's a perfect illustration, yeah. Classic IRS squeeze. Donald and Regina owed about $4,500 in income taxes from way back in 1982 and 83. Couldn't pay it then. Plus, they had about $9,000 in just regular unsecured debt, credit cards mainly.
Okay, old tax debt plus other debt. What was the immediate problem?
The immediate problem was that 80% wage levy. The IRS was taking almost all of Donald's paycheck right now. They were financially paralyzed.
That 80% again, just crippling. So Geraci's analysis showed two potential bankruptcy solutions for them, right? Depending on the specifics of that old tax debt.
Exactly. It highlighted the different outcomes. The main goal was stopping that levy, like yesterday, and finding a sustainable path. Because the taxes were from 82 and 83, quite old. If they met all those Chapter 7 rules we talked about, return filed, past the 3-year mark, past the 240-day assessment,
If they qualify.
then Chapter 7 was the home run. It would completely eliminate the $4,500 tax debt and wipe out the $9,000 in credit card debt. Boom. Total fresh start. Levy stops, all debt gone.
Wow. Okay, that's the ideal. But what if, for some reason, maybe an assessment was recent or something, those old taxes didn't qualify for Chapter 7 discharge?
Right. Even if Chapter 7 couldn't wipe out the tax part, Chapter 13 still offered a complete solution to the crisis they were in.
How so?
Well, filing Chapter 13 would still immediately stop that devastating 80% wage levy because of the automatic stay. That's the first win.
Okay, immediate relief from the seizure.
Then, the Chapter 13 plan would force the IRS to accept repayment of that $4,500 tax debt over time, maybe 5 years. And remember, usually without more penalties and interest piling up.
Right, and the credit cards.
The Chapter 13 plan would handle those too, often paying pennies on the dollar or sometimes nothing, depending on their overall situation. But the calculation showed their total monthly payment for everything, the IRS repayment, trustee fees, maybe a tiny bit to credit cards, would be around $250 a month.
So they go from losing 80% of a paycheck to a manageable, fixed $250 payment for everything.
Exactly. It turns an absolutely impossible situation into a structured, affordable budget, all under the protection of the court. Huge difference.
It really brings it home. So when we boil it all down, the big advantages of using bankruptcy to tackle tax debt, whether you get a full discharge or not, seem to center on gaining control and leverage back from the IRS.
That really is the bottom line. You hit it. First, yes, there's that unique power to potentially eliminate old qualified income taxes entirely in Chapter 7. That's huge if you qualify.
Huge.
Second, and maybe even more universally important, is the immediate power of the automatic stay. Stopping those aggressive IRS levies and garnishments the second you file, that's often life-saving. It buys you time and peace of mind.
Absolutely critical breathing room.
And third, if the tax debt itself can't be wiped out, Chapter 13 provides that structured path. It forces the IRS to accept a reasonable payment plan, often interest and penalty-free during the plan, that you can actually manage. It puts you back in control of your budget.
And let's not forget the side benefit. While you're dealing with the taxes through bankruptcy, you're often simultaneously wiping out or drastically reducing all that other unsecured debt, credit cards, medical bills, personal loans.
That's a massive point. Freeing up that cash flow makes dealing with any remaining priority debt, like taxes you have to repay in Chapter 13, much more feasible. It tackles the whole financial picture.
So, thinking about this leverage, if bankruptcy gives you this kind of control, either wiping the slate clean with old taxes or forcing an affordable plan for newer ones, and stopping the immediate bleeding, what's the real cost of just waiting for the IRS to make the first move?
Well, given their unique power, that power to take 80% of your income without even asking a judge, the cost of inaction can be immediate total financial devastation.
It really underscores the idea that understanding your options and the timing of when to act is absolutely crucial when you're facing down tax debt. Waiting might feel easier, but it could cost you almost everything.